If you're watching this video and your heart is racing because you just saw the spot price of silver plummet 22% in a single trading session, I need you to take a deep breath and listen very carefully. Yesterday, when everyone was celebrating the all-time highs, we released a warning. We told you specifically that the bullion banks were preparing a liquidity event. We told you they would defend the triple-digit psychological barrier with everything they had. And most importantly, we gave you a specific number. We said that before the real breakout to $150 happens, they would smash the price down to test the $95 support level. Look at your screen. Look at the low of the day. We hit exactly $95.50 before bouncing. This was not an accident. This was a calculated assassination of the paper price. And if you panicked and sold, you played right into their hands. Welcome back to the Boring Currency Archive. Today we are not just analyzing charts, we are dissecting a crime scene. What happened this morning at 8:30 a.m. Eastern Standard Time was a textbook stop run. The algorithms triggered a cascade of sell orders designed to flush out the weak hands, the retail investors who bought at the top because of FOMO. The banks saw the leverage building up in the futures market. They saw that too many people were long on margin, so they pulled the rug. They dumped billions of dollars in paper contracts to force a margin call event, crashing the price from $122 down to $95 in less than an hour. But here is the detail that the mainstream media is hiding from you. While CNBC is running headlines about the silver bubble bursting, the physical market tells a completely different story. At the exact moment the paper price crashed to $95, the Shanghai Gold Exchange was trading silver at a premium of nearly $40 above the COMEX price. Do you understand what that means? It means the crash is fake. It means that while Western investors are being scared out of their positions by a digital illusion, Eastern sovereign funds are backing up the truck and draining the physical vaults at a massive discount. You are witnessing the greatest arbitrage opportunity in history, but only if you have the courage to ignore the red candle on your screen. This drop to $95 is the bear trap we warned you about. It is the final shakeout. The banks know that once silver decisively breaks and holds above $100 for 3 consecutive days, their control is lost forever. They cannot stop the momentum. They can only delay it. And the only way to delay it is to create extreme volatility that makes you question your conviction. They want you to think the bull run is over. They want you to look at the 22% drop and feel pain. But the smart money, the wolves, are looking at that same drop and seeing a gift. We are going to break down exactly why this level held, why the bounce is already starting, and why the next leg up will be violent enough to bankrupt the institutions that engineered this crash. Let's look at the anatomy of this crash, because if you understand the mechanics, you cease to be a victim and you become a predator. Why did we predict the $95 level specifically? Because that is where the algorithmic kill switch was located. The bullion banks, JP Morgan, Citi, HSBC, knew that thousands of retail traders had placed their own stop-loss orders right below the $100 psychological barrier. They knew that if they could push the price just a few dollars below 100, it would trigger a chain reaction of automatic selling. This is called a long squeeze. The banks didn't have to sell billions of ounces of real silver to crash the price 22%. They just had to sell enough paper contracts to trigger your sell orders. Once the first domino fell at $99, the algorithms took over and drove it straight down to our target of $95. This was a high-frequency trading attack, executed in milliseconds, designed to wipe out the leverage in the system. If you were trading on margin, you got liquidated, you lost your position. And who do you think bought those contracts at the bottom? The same entities that initiated the crash. They sold high to start the panic, and then they bought low to cover their own naked shorts. It is a transfer of wealth from the impatient to the patient, from the emotional to the strategic. The $27 drop we just witnessed was not driven by fundamentals. Did a silver mine suddenly discover 1 trillion ounces of new supply overnight? No. Did the industrial demand from solar panels and EV batteries vanish this morning? No. The fundamentals are stronger than ever. This was purely a paper game played on the COMEX to reset the sentiment. But here is the most critical part of the puzzle, the physical disconnect. While the spot price on your screen was flashing red, try finding a physical dealer who was lowering their prices by 22%. You couldn't. The premiums on American Silver Eagles and Canadian Maples actually increased during the crash. Why? Because the physical market knows the truth. The dealers know that $95 is a steal. They are not going to sell you their inventory at a discount, just because some algorithm in New York decided to paint a red candle. This divergence between the paper price, which crashed, and the physical price, which held firm, is the ultimate signal that the bottom is in. The paper market is a lie, and today that lie was exposed for everyone to see. We are seeing a bifurcation event. The paper market is volatile, crashing and spiking based on fear, while the physical market is slowly draining dry. The banks are playing a dangerous game. By crashing the price to $95, they have made physical silver affordable again for the masses. They are practically begging you to take delivery. And that is exactly what is happening. The reports coming out of the vaults today show massive outflows. The smart money used this dip to secure thousands of ounce bars. They didn't panic sell, they panic bought. This is the difference between the sheep and the wolf. The sheep sees a price drop and runs away. The wolf sees a price drop and attacks. The $95 level wasn't a coffin, it was a trampoline. And we just hit the springs. Now, let's zoom out and look at the battlefield from the perspective of the generals, not the foot soldiers. Why did they crash it exactly to $95? Why not 80? Why not 50? Because $95 was the liquidity pool. It was the exact price point where the maximum amount of pain could be inflicted on the bulls without breaking the long-term uptrend. They needed to touch that line to clear the board, to reset the indicators, and to reload their own long positions for the next leg up. This wasn't a random number generated by chaos. It was a sniper shot. And if you were watching our video yesterday, you knew the coordinates. You were ready, you didn't panic, you prepared. But here's the catalyst that turns this 22% crash into a vertical recovery. While the COMEX in New York was busy painting the tape red, the Shanghai Gold Exchange in China was trading silver at a premium of nearly $40 over the spot price. Do you understand the arbitrage that exists right now? You can theoretically buy a paper contract in New York for $95 and physically deliver it in Shanghai for $134. This is an arbitrage window that cannot stay open. The laws of economics dictate that it must close. And it will not close by China lowering their price. It will close by the COMEX ripping higher to meet reality. The West is trying to suppress the price with paper, while the East is draining the physical inventory with real demand. We are witnessing the slow death of the paper market. The bullion banks are trying to suppress the price with infinite leverage, but the physical market is calling their bluff. Every time they smash the price down, the physical inventory disappears faster. It is Gresham's law on steroids. Bad money, the paper contracts, drives out good money, the physical bars. The more they manipulate the price down, the more the East drains the West. The vaults in London and New York are bleeding silver at a rate we have never seen before. And when the vault is empty, the game of musical chairs stops. The music stops. And the only people with a chair are the ones holding physical metal. This dip to $95 is the fuel for the rocket. A market cannot go up in a straight line forever. It needs to breathe. It needs to shake off the weak hands. This crash was the market taking a deep breath before the sprint to $150. The RSI, Relative Strength Index, on the daily chart has just reset from overbought to oversold in a single session. The energy is coiled, the spring is compressed. And the banks, who are still net short, are now staring at a coiled spring that is about to explode in their faces. They tried to break the bull market, and instead, they just gave it a second wind. This is the moment where the wolf separates from the pack. The pack sees the red candle and screams, "Crash!" The wolf sees the red candle and whispers, "Discount." The pack sells at the bottom because they are afraid of losing more. The wolf buys at the bottom because he understands the value. You have to decide right now which one you are. Are you going to let a 22% drop scare you out of the greatest wealth transfer in history? Or are you going to use this volatility to your advantage? The $95 level is held. The trap has sprung. And now the hunters become the hunted. So, what is the strategy now? We are not here to predict. We are here to prepare. The crash to $95 was the buying opportunity you prayed for when silver was at $120. Now it is here. The window is open, but it is closing fast. The physical market is screaming that the bottom is in. The premiums are diverging. The arbitrage with Shanghai is massive. This is your generational entry point. The banks have given you a gift, wrapped in fear and red candles. Do not refuse it. Do not let them steal your future. You need to understand that this is not just about price action. It is about survival. The paper market is a casino where the house always wins, until the house runs out of chips, and the house is running out of physical silver. Every time they crash the price, they bleed real metal. They are cannibalizing their own vaults to keep the illusion alive for one more day. But the math is undeniable. You cannot print silver. You cannot derive it from thin air. When the physical shortage hits, and it will hit suddenly, the paper price will become irrelevant. The only price that will matter is the one you can hold in your hand. Do not be the person who sold at $95 because you were scared. Do not be the person who waited for $70 and missed the boat entirely. Be the person who saw the manipulation, understood the game, and acted with conviction. Accumulate physical silver. Buy the dip. Use this volatility to lower your average cost. And if you're already fully positioned, just hold. Do not let them shake you out. Turn off the news. Ignore the noise. Look at the long-term chart. The trend is up. The fundamental drivers, debt, inflation, industrial demand, are stronger today than they were yesterday. Nothing has changed except the price tag. This 22% crash is the final test of your resolve. The weak hands have folded. The leverage has been wiped out. The market is cleaner, lighter, and ready to soar. We are heading into the parabolic phase. The $95 level was the floor. The next target is $150. And when we break that, there is no resistance until we hit the moon. The banks are done. The squeeze is accelerating. The rocket is refueling on the launch pad. Do not be left behind.